You're watching Stock Watch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Pierre Verster from Protea Capital Management and Mark du Toit from Oyster Capital Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or an X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. I did see Naspers and Process up today by, I think, almost 3%. Leading in that top five major moves on the JSE, and I'm wondering, JP, if it's all the information we got on the Chinese economy.
It does look that way, Zinati. So quite strong economic news from China. It looks like hopefully they are getting to the end of a very tough period. Still some deflation around in the economy, but all the technology stocks, or most of the technology stocks that are listed on the Hong Kong exchange, rose quite nicely, including Tencent. The rand also weakened a little bit. And if you take a combination of a higher Tencent price and a weaker rand, that was a nice boost for both Naspers and Process on the market today, yes.
All right. Well, Mark, how did you digest that information? And actually, interesting that we've seen the tech shares go up, but also, has that had any impact on our mining stocks? I didn't particularly see any noticeable moves today. Mark?
Yeah, so I mean, I guess the other bit of information that came out is that Nvidia might get permission to sell its chips into China again. So I think that was also quite positive for the Chinese tech stocks. And then a decent Chinese GDP print. The miners not really taking much notice of it today, but the mining stocks have been a little bit stronger of late. It's more actually around about a weaker dollar propping up commodity prices. But yeah, a stronger Chinese economy is normally good for resource counters.
Yeah. Talking about mining, we also did have some economic data out. I don't know, though, how significant. Mining output was up 0.2% year on year, and that's in May, like 2 months ago. But I mean, JP, we'd seen an environment where mining output was contracting, and this is the first time in a number of months, about 6 months or so, that we actually saw an uptick, particularly in iron ore. Could this be a better environment for the mining companies in that mining production could be changing its trend and improving, but also with what we're seeing with the shares and the prices, could we kind of see better fundamentals on the mining front?
It does seem like generally things are a bit better for the mines of late. Firstly, the operating environment is better than, let's say, a year or a bit ago. Less cuts in electricity. The labor situation seems to have settled down. There is some bad news from Transnet. If you read the latest news from ArcelorMittal, they said that Transnet had some issues recently that made their performance almost the worst they've experienced. So that makes one a little bit worried if you think about Thungela, Exxaro, Kumba, that are very reliant on Transnet. So that's one concern that one might have. But a lot of commodity prices are quite a bit higher also in the last few months, principally the PGM space. So the platinum miners have done very well. The share prices have done very, very well. And the gold miners as well. They are at record levels in terms of the difference between the spot gold price and their all-in sustainable cost. So between the gold and the platinum miners, there's definitely a bright spot in the mining sector.
Yeah, and actually just talking about the mining sector, we did have in our lunch show July Ndlovu on as he retires. And of course, I think in the last week or so, we have seen some buying activity in Thungela. I think there was a spike of about 10% on one day last week. I did also have a short-term trader actually saying that he would be taking a nibble at Thungela at these levels, but also pointing out that over the long term, investors haven't really been happy about this stock. How would you be viewing Thungela at this point, Mark? And do you think that it could have reached a bottom at this stage, or is it too early to tell?
Yeah, so it's been interesting that the thermal coal prices have been under pressure in the first half of this year, and they seem to have found a level now, almost a floor. So the prices are into what's called the cost curve. So some coal mining stocks are making losses at the current coal price. So which means that their mines will at some point shut or be just curtailed until the prices recover. So Thungela is not in that boat. So they are. I think their latest or their numbers that they're going to present in the next month or so will show pretty much break-even levels. So I don't think they were loss-making at these prices. And if the coal price goes up, then they will do really well. Also, if the rand weakens, I mean, a lot of their costs are in South African rands, so that would also be positive for them. So it really is a story about coal prices. If the coal price can actually go up from this level, then I think Thungela will do very well. So it's very difficult to predict exactly how high coal prices can go. And also we've seen China's had a very hot summer, and so the air conditioning's been running full tilt, and they're starting to consume more coal in their power stations. So that's also been supportive of the coal price in the last sort of month or so.
All right. Well, gents, let us get to the questions. Two viewers with questions on BAT. Firstly, JP, why is British American tobacco going up?
Well, all the tobacco stocks have been going up quite sharply over the last, let's say, 18 months. So there definitely is a trend. I think for quite a few years, people have been concerned about the decrease in prevalence of traditional smoking of cigarettes, but the offset has been the next generation products. And some of these spaces have done better, like Philip Morris, for instance, have got the Zin product after they bought a Swedish Match, and that has done very well. That's the pouch of tobacco you put in your upper lip, between your lip and your gum, which sounds strange, but apparently the American youth love it.
I've seen it.
Yes, and you apparently get a very quick hit of nicotine because it goes straight into the blood circulation. So I think people are focusing less on traditional cigarettes, which is a shrinking market, and taking a lot of comfort from the gains that these new generation products, whether it is vaping or then these pouches, the nicotine pouches, have made. There's been a lot of illicit products, especially in the US as well, from China, and all these players are moaning about it, and hopefully the US will clamp down on that.
Yeah.
But it seems to be almost driven more by sentiment than anything else. These are very cash generative businesses, so even if they don't grow a lot, as long as they pay off their debt, like British American Tobacco has done, that sort of leverages your profit growth. So we've seen a lot of good things from these tobacco companies of late.
The second viewer is asking, BAT share prices increased 55% year on year. Should I sell or buy more? And that is the question. Should you take your profits and run or buy more? Mark?
Yeah, well, I mean, we always say that the share price has no memory, so it doesn't know where it's come from. It's all about what's going to happen tomorrow. And so it doesn't matter if the company or your share price is going up 50% or down 50%, you have to make the decision today based on the future.
Yeah.
We like to look at all our investment opportunities and rank them against each other. And then let's say if you think that Naspers is going to give you better returns over the next 5 years, then you should sell your BTR and buy Naspers. So I think, for us, we haven't been buying BTR at this level. We think that the price is looking fairly full now. But if you don't have a better idea, then you rather stick it out with what you've got.
All right. Well, let's get into Invicta. Please give us some analysis and insight into this company as a potential buy opportunity. Would you be looking at, firstly, JP, the SA industrial space at this point?
Selectively. And Invicta is one of those South African industrial companies I would selectively look at. So they distribute all kinds of spares and bearings and motors and all kinds of things that get used in heavy machinery and plant and other equipment. And, things break the whole time. So you always need spares. So these businesses always have customers. They generally have got quite high margins, but low inventory turns, because sometimes you sit in a part for 2 years and it doesn't break at any of your clients, and then you don't sell it for 2 years. So you make good money when you sell something, but you don't always sell it very regularly. So that type of dynamic means that you need to hold a lot of inventory. That depresses your returns on assets. But over the long term, these businesses have generally kept pace with inflation when it comes to their profit growth. In the case of Invicta, they've made a lot of acquisitions, some disposals as well, like a property in Asia, in the Key and Ann business. And they've made some acquisitions offshore. And it sounds like they actually want to get more than half their profit in the next few years outside of South Africa. And that could be interesting. When they reach that, they might even decide to get a listing offshore. And foreign investors might look at this company and be more positive about it and give it a higher rating, as we call it, a higher valuation. So there's a few things that tick the box when it comes to Invicta. They've had some issues in the past, a little bit too much debt, some indigestion from previous acquisitions. But where they are now with a relatively new management team that came in, I think, about 3-4 years ago, it looks to be on a decent footing. So it's one that I would definitely look at, yes.
Yeah, but the shares taken a little bit of a beating in the last few days. Mark, would you be looking at this as a buying opportunity, or maybe something to maybe be a little bit concerned about?
Yeah, I mean, I haven't heard anything concerning about Invicta. I mean, what I know of the company is actually quite a nice, solid little business, and they do have the offshore exposure in East Asia. So yeah, I think it probably does look quite interesting. It's probably going to be one of the shares that doesn't have doesn't do a lot until either one day it gets bought out or it gets listed on a different exchange. But yeah, I think if you hold it for the longer term, you probably will have a fairly decent return.
Let's get to more questions. There's a question on IOCO, previous EOH. The share price increased, and in the last week, it increased significantly. With the current, so yeah, they talk about how they bought it at R3.67, current levels at R4.20. As my portfolio is on a profit, is it a good idea to leave it for 4 more years? Okay, so buying it at 3.67 and now at 4.20. There's a profit there. And I mean, yeah, this is clearly an investor who's been in the company for a while, who's been holding for a while and hoping for a little bit of an uptick. Mark, yeah, I mean, is it clear cut on whether they should be holding on for more, hoping for more, or maybe just take your profits because you've been holding for so long and waiting for this moment?
Well, I mean, I think that if you're going to sell IOCO and you're going to buy something which you think is going to have a better return, then that's a good idea. If you're just going to sell it because you like to lock in a profit, I don't think that's particularly the best course of action. I mean, it is the old EOH that's gone through a real serious restructuring process, and it sounds like it's actually starting to do a bit better. It's a tough environment to sell software services, but it certainly seems like there is a bit of a turnaround happening. Yeah, so I would say, either hold it and see if you can eke out some more returns, unless you've got a better stock that you would like to invest it in.
Yeah, I mean, this is quite something that it's gone over R4. JP, do you think that there's more juice there?
It's an interesting question. Look, turnarounds are very interesting, and some of your best returns that you can generate are when you buy turnarounds very, very early, and then they do turn around. They can go up a lot, but it needs a successful turnaround for that to happen. Which probably also means your starting point needs to be a terrible situation that the company was in. Now, EOH was in a terrible situation, and they needed to do a lot of work. They sold a lot of their best businesses, and they then installed a new management team with a new significant shareholder roughly a year ago. So it's still early days. The jury is still out. And there's a lot of uncertainty whether the sharp increase in the share price the last year is because of positive sentiment or whether there are some operational indications of improvement. I haven't really seen the operational improvements yet.
Okay.
So personally, I would wait for the next few sets of results. And if you don't see significant improvement in the financial results, I would move on to something else. But if there are significant improvement in the actual operating performance, then I would say you can probably hang on for the ride a bit longer.
Okay. Let's take a look at EPE Capital Partners, Ethos Capital. Can you please ask what your panel thinks of EPE Capital Partners at the current level? That is about, just over R6. Mark?
Yeah, so I unfortunately don't know much about the business. Just to say that when you look at holding companies or companies that invest in other assets, you always have to remember that there's a fee that the management are charging, and typically your business will always trade at a discount to the sum of its assets because of the fees that are being taken out by the team. But as to the value of Ethos, I can't offer an opinion.
Yeah. Also, didn't they break away from Braid or release their holding in Braid? JP, your thoughts on Ethos at this point?
Yes, so Ethos had some Braid shares which they effectively unbundled because they didn't want to follow another Braid rights issue.
Yeah.
With hindsight, they should have held on to those shares and put in some more money, but it's easy to say in hindsight. And that the change also because Ethos, the actual management company, was taken over by the Rohatnan group. So a lot of changes, and that means that shareholders put pressure on Ethos to effectively liquidate. So they are on a liquidation drive that will, the expectation is that will narrow this gap to the net asset value per share. The fees have also been renegotiated to be a lesser fee, more of a fixed type fee. So all of these things are positive, but we don't know how long it's going to take for them to finalize this liquidation of the portfolio. The biggest company that they hold is Optasia, which is a company that is involved all around the world, but specifically in Africa in airtime advances, a very profitable company. But we also have a lack of information about exactly how profitable. They sometimes give you EBITDA numbers, but I always like to know also what does the balance sheet look like that's generating the profits that I see on the income statement. And I haven't seen an Optasia balance sheet. So without having all the information, I'm a bit lukewarm on Ethos Capital Partners. But I think there could be some corporate action in the next year when it comes to Optasia. Who knows? Maybe another listing on the JSE. That would be nice. And then one can reassess and see how quickly they can get to this end point of Ethos Capital Partners liquidation drive.
All right. We'll talk about balance sheets. A balance sheet that a ratings agency, GCR, is confident on is Lewis. And we actually saw that share price surging by almost 5% today. So GCR is saying that they affirm their national scale rating, but also improving their outlook from stable to positive. Lewis, at this point, does it seem like the runway is long for its growth, Mark?
No, I mean, I think that for us, we prefer to concentrate on some of the bigger retailer names.
Yeah.
So our preferred kind of stock is Foschini Group in that kind of grouping. But yeah, I mean, Lewis has its own eccentricities. But it's not a stock that we look at in great detail.
JP, when was it? I think a few weeks ago I asked you about good companies and there was a question on that.
Yields.
You mentioned Lewis and the dividends. Yeah, what do you make then? Does this then confirm and actually beef up what you said about Lewis and just your view on the company going forward?
Yes, I do think more and more people and other institutions are recognizing the value in Lewis and also the good turnaround that they've delivered. So we spoke a bit earlier about turnarounds and how profitable they can be. I picked up some Lewis shares. I think it was below 20 Rand a couple of years ago. and now they're trading above 70. Excuse me. And I got a few good dividends out of the company as well. So it really has been a very, very strong performer over the last 3 to 4 years. I still like the company. They fixed the credit side of the business. People will still buy furniture. So that means that the returns are improving, the demand is stable, they run a tight ship, and they make good capital allocation decisions. Big share buybacks that they bought back below the tangible net asset value of the company. And the return on capital is now slightly above the cost of capital, which means if you can buy back shares below book value, but your returns are higher than your cost of capital, you can justify a fair value of above your net book value per share. So I like the decisions that they make in terms of allocating their cash. So I still like Lewis even at the current price, yes.
Okay. Something else that you liked, but not a lot of people liked it today. So I'm going to ask Mark this question. Italtile. It's actually down more than 3% on the day. And I actually think there was a climb in the share price last week. Actually, I think, JP, it was after you chose it as your stock pick. I think it was up about 5%. And I was like, I should have listened to JP. But now I'm like, I don't know. It's down 3%. Mark, how do you look at Italtile and just, I guess, the general building materials sector? Because I think after JP, someone actually chose Cashbuild as their stock pick.
Yeah, so I mean, the first thing I would say is like a 3% move in a stock price is not that significant. I mean, it's often not kind of due to anything that's happened to the company on that day. It could just be a large seller in the market, or it could be that the sector's under a bit of pressure on the day. So Italtile, I mean, it is a great small business. I think it has, if we can get a bit more economic growth in South Africa, and we do expect that to start coming through. It's been a bit delayed because of all the tariff news and the announcement of the tariffs on South Africa. But we do expect better economic growth in the medium term, and that will benefit all the companies selling into the South African market, including Italtile. And it is a well-run business, and it deserves to trade on a reasonable multiple. So yeah, I would, if you're bullish South African economy, then I think you can actually buy Italtile, and you're getting it at a 3% better price today, apparently.
And Zanati, in my defense, I did not pick it for a week, so please don't judge me after 1 week.
Cool. We'll keep that in mind. We're talking about bullishness. Let's get to your stock picks for today. JP, what are you choosing?
I'm picking an offshore share, Adobe. So I'm sure a lot of people know PDFs, but Adobe makes a lot of software. Their Creative Cloud has got a whole suite of different design software products that they offer for subscription. And those subscriptions are very sticky. Sometimes so sticky you miss the small print of canceling your subscription, and when you see, oh my goodness, my credit card has been debited and I'm a subscriber for another year. So that's the nature of software subscriptions. People were very concerned about AI, as well as other software packages that compete with Adobe that offer AI, and thought they might lose market share, and that has put pressure on the share price. But of late, it does seem like Adobe are pulling up their socks and integrating AI into their suite of software products. So I do believe that they have turned a corner. They've learned a lesson. They are seeing the risk of AI, and they're incorporating it. And therefore, that what has been discounted in the share price is perhaps overly negative. And that is why Adobe is my stock pick tonight.
All right. Mark, where are you finding value today?
Yes, tonight I'm picking Old Mutual. So we do think that there's a lot of value in Old Mutual, and now that Old Mutual is getting the new CEO, Yuri Stradum, we think that there'll be opportunity to unlock that value. I think there's a couple of kind of quick wins that he can go for. They've already changed the divisional reporting structure. We think that they can reduce kind of central head office costs a bit. Once they get their own bank to go from a loss-making to a profitable position, that will be accretive. They've sold some of the loss-making African businesses already. So I think that there's a lot of self-help within Old Mutual. And also, it's one of the insurers that's quite geared to equity market performance. So we've seen pretty good performance out of equity markets of late, and that will also benefit the Old Mutual. Plus, they've got excess capital. So we talked earlier about capital allocation decisions. We think that that capital can be returned either through share buybacks because it's trading below its book value, or even a special dividend. And all these things added together will give you a good return over the next 3 to 4 years. We think even maybe 20% a year for the next couple of years.
All right. Thank you so much for your time and for your analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guest, Pierre Verster from Protea Capital Management and Mark du Toit from Oyster Investments. Up next, The Close. Stay watching.
Thank you.